The live entertainment industry, long plagued by disruption and dislocation during the pandemic, made a roaring comeback in 2022 and 2023. Artists like Taylor Swift and Beyoncé not only filled stadiums but broke records, fueling a surge in secondary ticket sales. StubHub, as the leading ticket resale platform in North America, emerged as a direct beneficiary of this cultural and commercial phenomenon. Riding the wave of record-breaking demand, the company now seeks to capitalize on its momentum through a long-anticipated initial public offering. But this IPO comes with an eyebrow-raising price tag. StubHub's target valuation of $16.5 billion implies more than 9 times trailing revenue and a staggering 60 times adjusted EBITDA, multiples that exceed even some high-growth tech companies. With competitors like Vivid Seats and Live Nation trading at steep discounts on similar metrics, the central question for investors becomes, can StubHub justify such a lofty valuation? The pandemic-induced shutdown of live events left the ticketing industry in disarray, but the reopening brought about a renaissance. Consumers, flush with excess savings and a newfound appreciation for in-person experiences, flocked to concerts, sports events, and festivals. This revenge spending led to a dramatic rebound in ticket sales, and secondary marketplaces like StubHub thrived. In 2023, StubHub sold over 40 million tickets and grew revenue by 29% to $1.7 billion. These headline numbers reflect not only a recovery but an acceleration, particularly during the Eras Tour and Beyoncé's global stadium shows. Yet these superstar events are outliers, not guarantees of future recurring growth. The question is whether this boom is sustainable or if it represents a one-off spike. StubHub's headline revenue growth is impressive, but peel back the curtain and profitability remains elusive. The company posted a net loss of $2.8 million in 2024, weighed down by heavy operating costs and a high interest burden from its $1.3 billion debt load, equivalent to 4.5 times adjusted EBITDA. Moreover, costs surged nearly 50% last year to $1.6 billion, largely driven by aggressive sales and marketing spending, which alone accounted for over half of total expenses. Such spending is typical for a tech company chasing growth, but StubHub is essentially a transactional platform, not a proprietary ecosystem business. So the market is already skeptical. Vivid Seats, a direct competitor, has seen its market capitalization fall by 76% since going public in 2021. It trades at just 0.5x revenue and 10x EBITDA. Even Live Nation, with its vertically integrated model that includes ticketing, promotion, and venues, trades at only 1.2x revenue and 18x EBITDA. StubHub's multiple of 9 times revenue and 60 times EBITDA places it in an entirely different valuation stratosphere. To justify tech-like multiples, StubHub must demonstrate that it's more than a ticket reseller. Management has outlined several growth initiatives. Primary ticketing. The company wants to move upstream into primary ticket issuance, currently dominated by Live Nation's Ticketmaster. This transition is complex, requiring relationships with artists, promoters, and venues. Success is far from guaranteed. Digital advertising. Leveraging its large user base and high-intent search behavior, StubHub sees advertising as a monetization lever. Yet it competes with giants like Google and Meta, and ticketing lacks the frequency of engagement needed for meaningful ad revenue. Sports betting. With regulatory tailwinds and rising interest, StubHub aims to integrate betting features for live sports ticket buyers. While potentially synergistic, this space is fiercely competitive and heavily regulated. These ambitions are credible but speculative. Each comes with execution risk, capital requirements, and entrenched competitors. The total addressable market may be large, but StubHub's ability to carve out meaningful share remains uncertain. StubHub's balance sheet reveals a classic pre-IPO playbook: fuel growth with debt, then use IPO proceeds to deleverage. With $1.3 billion in net debt, the company's interest expense is a significant drag on profitability. While management intends to use some IPO proceeds to reduce leverage, there is no clarity on the post-IPO capital structure. Without a concrete debt reduction plan, valuation multiples become more difficult to justify. Moreover, a high debt load in a rising rate environment increases vulnerability. If ticket sales slow Saturday due to consumer belt tightening, geopolitical volatility, or reduced touring, the fixed cost of servicing debt will become a more pronounced burden. The secondary ticketing market has become more crowded and contested. Aside from Vivid Seats and SeatGeek, even Ticketmaster has expanded into resale. StubHub's user base and brand recognition offer some insulation, but not immunity. Switching costs are low and price sensitivity is high. Regulatory scrutiny also looms large. Politicians and consumer advocates have long targeted secondary ticketing platforms for opacity in pricing and enabling scalping. In both the US and abroad, calls for legislation mandating price transparency, resale caps, and fee disclosures are gaining momentum. Any regulatory move that caps fees or requires operational changes would directly impact StubHub's margins, particularly as the company currently keeps about 20 cents on every dollar of resale. StubHub's co-founder and CEO Eric Baker will retain control via super voting shares. While common among tech IPOs, this structure often raises red flags for institutional investors wary of entrenched leadership. Founders' control, when not balanced by strong governance mechanisms, can lead to misaligned incentives, resistance to strategic change, or mismanagement. Investors burned by similar structures in companies like WeWork or Snap may hesitate to endorse such arrangements again, particularly at inflated valuations. From a discounted cash flow perspective, the implied valuation requires aggressive assumptions, double-digit annual revenue growth, significant operating leverage, and eventual EBITDA margins above 20%. Yet StubHub's current EBITDA margin is roughly 2.6%, $28.3 million EBITDA on $1.7 billion revenue, with high SG&A intensity. Getting to 20% margins means radically reducing customer acquisition costs, increasing repeat usage, and maintaining pricing power, all of which face structural challenges. In a best-case scenario, StubHub grows revenue at 20% CAGR for 5 years and reaches 15 to 20% EBITDA margins. Even then, a 60x multiple suggests extreme optimism. A more realistic peer-based valuation, say at 15 times EBITD, would imply a valuation close to $3 to $4 billion, not $16.5 billion. For growth-focused investors, StubHub's IPO may appear as a call option on transforming the ticketing industry. If management executes flawlessly and adjacent businesses scale, the upside could be significant. For value-oriented investors, however, the fundamentals do not support the price. The company is unprofitable, faces rising costs, intensifying competition, and unclear regulatory risks. The capital structure and governance also pose red flags. Ultimately, StubHub's IPO is not for the faint of heart. It may appeal to those with long horizons and high risk tolerance, but for most institutional portfolios, the current valuation likely fails to meet return hurdles. StubHub's role in reshaping ticket resale is undeniable. It has scale, brand recognition, and a valuable position in a niche market. But its IPO valuation appears rooted more in aspirational growth than in fundamental performance. To justify a $16.5 billion valuation, StubHub must prove it can evolve beyond ticket brokering into a diversified, high-margin platform. That journey requires flawless execution, regulatory luck, and sustained consumer appetite for live events, all in a rising rate, competitive, and skeptical market. In its current form, the IPO seems more like a speculative play than a fundamental investment. Until the strategy matures and the numbers follow, investors may want to stay in the mezzanine or skip the show entirely.